I want you to do something for me right now. Open your phone. Pull up any major financial news headline. Read it. Now ask yourself one question. Does that headline mention a nuclear detection aircraft? Does it tell you about B-52 bombers sitting on a runway miles from the Iranian border? Does it reference a vault in New York that is hemorrhaging 20 million ounces of silver every single month? No, it does not. What it tells you is that diplomats met for 3 hours in Geneva, that there was some progress, that maybe, just maybe, a deal is still possible. I want you to take that headline, fold it into a paper airplane, and throw it out the window. Because the people writing those headlines are not watching the same data I am watching right now. They are not looking at a military deployment map, dated February 17th, that shows 2 aircraft carrier strike groups over 100 fighter jets, Tomahawk-capable submarines, and a specialized aircraft whose only operational purpose is to detect nuclear material in the atmosphere, all of it positioned in a ring around one country. They are not looking at a precious metals market where the miners who actually dig silver out of the ground, who blast it out of rock, refine it, and physically deliver it to buyers, are receiving $69 in real settlement prices for an asset that the paper market quotes at $80. They are not counting the 88 million ounces of registered silver left in the COMEX vaults and dividing that number by the 20 million ounces that are draining out every single month. If they were running that arithmetic, they would not be writing about diplomatic progress. They would be writing about what you and I are about to walk through right now. You are watching the convergence of 3 separate crises. They are not arriving one at a time. They are not spaced out conveniently to give you room to prepare. They are landing in the same 72-hour window, a military trigger, a legal detonator, a physical inventory cliff. Each one of them, in isolation, would move the price of gold and silver significantly. All 3 arriving simultaneously represents the most concentrated catalyst cluster this market has seen in years. Welcome to what is actually happening. Ladies and gentlemen, Asian Guy here. T is Friday, February 20th, 2026. Gold is trading at $5,027.70 bid, up $32.50 on the session. Already pushing above $5,000 for the first time since its all-time high of $5,589 hit just 3 weeks ago. Silver is at $80.37, up $1.95 on the day, a 2.49% move, with a session high of $81.33 and a low of $77.39. At first glance, those numbers look like a market that already knows something, a market that is pricing in something before it is confirmed. A market that is not waiting for permission. I am here to tell you clearly that waiting right now is not a neutral act. Waiting is a decision. And before you make that decision, you need to understand what is unfolding simultaneously in 3 separate theaters. A military theater in the waters surrounding the Strait of Hormuz, a legal theater inside the United States Supreme Court, and a physical theater inside the COMEX registered vaults in New York. These are not separate stories with separate implications. They are a single converging event. And the direction in which they converge over the next 48 to 96 hours will determine whether gold and silver reprice violently upward or deliver a brief corrective window that immediately sets up the next leg higher. I have been covering these markets for years. I've walked through supply data, vault reports, miner earnings, and central bank flows. I've never had to open a script by discussing military deployment maps and nuclear detection aircraft alongside a precious metals analysis. That fact alone should tell you the weight of what we are sitting in front of today. I want you to hold 3 numbers in your mind at the same time. Not 1, 3, side by side. The first number is 80. That is what the paper market in New York says 1 ounce of silver is worth this morning. It is the number on your screen. It is the number quoted on every financial news ticker. It is the number most people will act on. The second number is 69. That is what the miners, the actual producers, the companies that drill, blast, refine, and physically deliver the metal, are receiving in real settlement prices for that same ounce after they navigate the paper market is delivery and settlement mechanics. 78 on the screen, 69 at the mine gate. Pause there. That gap is not a freight charge. It is not a storage fee. That gap is the paper market telling you, in plain arithmetic, that the price visible on your screen and the price at which the physical industry actually operates are 2 separate realities running in parallel. They cannot both be correct indefinitely. The third number is 99. That is what the Shanghai market is willing to pay for physical silver right now. Stand back and look at what these 3 numbers are describing. The paper market in New York says 80. The miners who produce the metal are receiving 69. The Eastern industrial buyers are paying 99. 3 prices, 3 realities, 1 underlying asset. In a healthy, functioning market, these numbers converge. Arbitrage forces them together. Price discovery does its job. But in a market operating under structural stress, where physical inventory is draining faster than it can be replenished, where the entities that set the paper price have a demonstrated interest in suppressing it, and where industrial demand is being driven by forces that paper traders cannot vote on. These numbers do not converge, they diverge. And right now, they are not just diverging. They are moving in opposite directions simultaneously, like tectonic plates separating under the surface of a sea that appears calm from above. Underneath all three of those prices, the COMEX vault sits with 88 million ounces of registered silver, draining at 20 million ounces per month, 4.5 months of runway. In a normal environment, on a normal week, that number is manageable. But this is not a normal week, and what the next 72 hours may add to that drain rate is not a rounding error. It is a multiplier. The compression spring is already wound. The question is what triggers the release, and how fast it moves when it goes. I want you to picture a specific scenario. You are the head of procurement for a major defense contractor. Your production line requires silver, not as a commodity hedge, as a structural input, guidance systems, satellite components, electronics for precision hardware. You cannot substitute aluminum. You cannot wait for a better quarter. Silver is in the bill of materials, and it has to arrive on schedule. This morning, your procurement officer sits across from you with a report that contains 3 data points. Data point 1, your primary delivery source, the COMEX registered vault network, currently holds 88 million ounces of registered silver. It is draining at 20 million ounces per month. At the current rate, that is roughly 4 months of supply before a delivery crisis becomes structural. Data point 2, the United States military has staged 2 aircraft carrier strike groups in the waters surrounding the country that controls 20% of global oil flow. Over 160 cargo flights have resupplied the region since January 16th. B-52 strategic bombers, nuclear capable, have been positioned at Al Udeid Air Base in Qatar, which is the forward headquarters of U.S. Central Command. A Trump advisor has publicly stated a 90% probability of military action. The USS Gerald R. Ford is currently en route to the eastern Mediterranean, and U.S. officials have explicitly stated that its arrival is a key factor in the timing of operations. Data point 3, China has dispatched 16 military cargo planes to Iran in the past month. Russia and China are conducting live joint naval exercises with Iran inside the Strait of Hormuz right now. Analysts confirm those exercises are designed to complicate any U.S. operational planning in those waters. Your procurement officer puts the report down. The question on the table is simple. If the Strait of Hormuz closes for even 2 weeks and global shipping lanes get disrupted, and the refined silver scheduled to move from processors in Switzerland and Australia gets delayed by an unknown number of weeks, on top of a COMEX vault already running at 4 months of runway, what do you do? And the answer requires no advanced degree in logistics. You do not wait for a lower price. You do not hold out for a better entry. You call every supplier with accessible inventory. You offer whatever premium they require, and you lock up your supply now before the procurement officer at the next desk makes the same calculation 2 hours from now and buys what you were going to buy. This is the mechanism. The physical shortage creates urgency. The geopolitical trigger eliminates the option to wait. And when industrial buyers, defense contractors, solar panel manufacturers, electronics assemblers, EV battery producers, all run the same calculation in the same short window, the $80 paper price in New York becomes a historical artifact. The real clearing price gets established by whoever arrives at the refiner's door with cash first. But why is this convergence happening now? Why are the military buildup and the market stress arriving in the same window? Because the deeper force driving both of them is the same. The accelerating erosion of the dollar system's authority to set prices and enforce outcomes unilaterally. Look at what the COMEX vault drain actually represents. It is not simply inventory leaving a building. It is the physical world refusing to validate the paper world's pricing claims. When miners accept $69 in real settlement for metal quoted at $80, they are not making an error. They are operating in a system where the settlement mechanics routinely deliver outcomes that diverge from the advertised price. That is what miner premium data tells you about the structural health of the paper pricing mechanism. Now look at the Iran situation through the same lens. Trump's administration imposed sweeping tariffs using the International Emergency Economic Powers Act. No president had ever used that specific statute for tariffs before. It was designed for sanctions during national security emergencies. The Supreme Court heard arguments in November. Both conservative and liberal justices expressed skepticism. The court has been deliberating for over 100 days, while the government has collected over $130 billion in tariff revenue. Revenue that may need to be refunded if the ruling goes against the administration. Here is the point most analysts are missing. The tariff regime and the Iran military buildup are both expressions of the same underlying condition: a United States asserting maximum economic and military authority at precisely the moment both are being challenged most aggressively from the outside. The tariffs are an assertion of economic authority. The carrier group deployment is an assertion of military authority. The Supreme Court ruling is a legal challenge to the economic assertion. Russia, China, and Iran operating jointly in the Strait of Hormuz is a physical challenge to the military assertion. Gold and silver sit at the intersection of both challenges. They are the assets that structurally benefit when institutional authority is questioned, when the ability of any single state to dictate the price of real things through paper instruments begins to erode. And right now, both pillars of that authority are being tested simultaneously in the same week, in the same news cycle. When a system operates at the edge of its design parameters, small catalysts produce large outcomes. The spring is not wound tight by accident. It is wound tight because we have arrived at the precise moment when multiple years of accumulated pressure find no more room to absorb. Now I need to give credit where it is due, because what China and Russia are doing right now in the waters around the Strait of Hormuz is not reactive posturing. It is not improvised. It is the operational execution of a deliberate long-range strategy. And you need to understand it, because it is the most direct threat to Western pricing authority over silver and gold that exists in the world today. In late January, China dispatched 16 military cargo planes to Iran. 16. Defense analysts report those aircraft likely carried defensive systems and logistical infrastructure, helping Iran rebuild the missile and air defense capabilities that were degraded by the June 2025 Operation Midnight Hammer strikes on its nuclear facilities. China is not a passive observer here. It has signed a trilateral strategic charter with Russia covering joint military exercises and intelligence sharing. It is providing cybersecurity infrastructure to replace Iranian communication systems, making those systems harder to penetrate. And it is purchasing 90% of Iran's oil exports, ensuring that the maximum pressure campaign intended to bring Iran to the table does not collapse Iran's economy before the negotiations conclude. Russia has agreed to supply Iran with 48 advanced Su-35 fighter jets. Russian Foreign Minister Lavrov has explicitly warned that any U.S. strike against Iran carries serious consequences, citing the risk of a nuclear incident from operations near facilities previously under IAEA oversight. And as of this morning, Russian warships, Chinese naval vessels, Iranian Navy units, and Iranian Revolutionary Guard boats are all operating in formation inside the Strait of Hormuz in a joint exercise designated Maritime Security Belt 2026. This is the CRINC alliance, China, Russia, Iran, North Korea, operating not as a loose coalition of shared grievances, but as a coordinated strategic bloc with a specific, demonstrable objective: to make the cost of U.S. unilateral action prohibitively high. The Strait of Hormuz deployment is the physical embodiment of that objective. By positioning Russian and Chinese assets inside the exact waterway where any U.S. military operation would need to maneuver, the alliance has executed a move of genuine sophistication. They have not attempted to match U.S. military capability, which they cannot do on short notice. They have made any U.S. operation more complex, more diplomatically dangerous, and more prone to accidental escalation simply by being physically present. Experts at the Center for a New American Security confirm that Russian and Chinese ships in those waters do not pose a direct military threat to U.S. forces, but they dramatically complicate operational planning. You must account for sensor arrays that could provide advance warning to Iran. You must ensure your munitions do not create an incident involving a Russian or Chinese naval vessel, and you must accept that any accident in those waters involving those platforms could transform what is intended as a limited strike operation into something with consequences no planning document anticipated. China and Russia are not in the Strait of Hormuz to fight. They are there to raise the price of fighting, and as that price rises, as the uncertainty premium embedded in every barrel of oil flowing through that strait increases, the case for gold. And silver as insurance against what that uncertainty produces becomes stronger with every hour those ships remain in formation. The establishment is watching this unfold. They can access the same deployment maps. They can read the COMEX inventory reports. They can see where the drain rate is headed, and they are not going to allow gold at $5,000 and silver at $80 to climb further without deploying every available instrument to push back. The counterattack is already in motion. And it is not coming from a trading desk. It is coming from the Supreme Court of the United States. Here is the specific mechanism. Trump invoked the International Emergency Economic Powers Act to impose tariffs across virtually the entire U.S. import base, 10 to 50% levies on goods from trading partners across every major region. Liberation Day tariffs, China tariffs, Canada and Mexico tariffs. The legal argument was that unprecedented trade deficits constituted a national emergency warranting executive action under the statute. Lower courts ruled that no president had ever used this law for tariffs, and that the action exceeded the statute's scope. The Supreme Court heard arguments in November. Notably, both conservative and liberal justices expressed skepticism about the breadth of the claimed authority. Justice Barrett herself used the phrase, a complete mess, to describe the implications of a ruling that would require refunds of tariff revenue already collected. Treasury Secretary Besant has warned publicly that the total refund obligation could approach $1 trillion by June if the court rules against the administration. Trump himself described this scenario as exactly that, a complete mess. And yet the court has held its decision for over 100 days while the government continues collecting tariff revenue every single day. Today, Friday, February 20th, that ruling may come. And here is why it matters specifically for silver and gold. The tariff regime is structurally inflationary. It raises the cost of imported inputs across the economy. It sustains pressure on the dollar. It reinforces the fundamental case for hard assets as a hedge against rising price levels. If the Supreme Court strikes it down, the immediate market reading is deflationary. The single largest source of administered inflation is removed. The dollar strengthens. In the short term, gold faces selling pressure and silver follows it down. That is the counterattack. It is not a blunt instrument. It is the judicial system, operating on a 100-plus day timeline, delivering a ruling that the establishment hopes lands as a cold interruption to the metals rally precisely when the geopolitical premium is at its most elevated. And it may work in the short term. A ruling against the tariffs could push gold back toward $4,500 and silver toward $70. That is the window the counterattack aims to create. But here is the structural flaw in the strategy. A court can strike down a statute. It cannot rebuild a COMEX vault. It cannot reverse the drain that has already removed 111 million ounces of registered silver over the past 5 months. It cannot put the 16 Chinese military cargo planes back in the air toward somewhere other than Iran. It cannot cancel the joint naval exercises running in the Strait of Hormuz. And most critically, it cannot undeploy the B-52 bombers sitting on a runway in Qatar, or send the USS Gerald R. Ford back to port before it reaches the eastern Mediterranean. The paper mechanism and the judicial mechanism have reach over paper. They have no reach over hardware that is already in motion. While the carrier's position and the court deliberates, a third front in this conflict runs quietly in the background. It is the front of managed perception. It is the one most likely to shake retail investors out of their positions before the real move occurs. And it is worth naming explicitly so you can recognize it when you encounter it. Watch how the Iran situation is being framed in mainstream financial media this week. The diplomatic track will receive prominent coverage. Envoys Kushner and Witkoff met Iran's foreign minister for 3 hours in Geneva. Both sides described some progress. Talks are ongoing. A deal remains possible. This framing is doing significant work. A U.S. official described that same meeting as a nothing burger. Vice President Vance stated publicly that Iran has not acknowledged any of the red lines the Trump administration has set. The precise preconditions Trump requires, permanent halt of uranium enrichment, limitation of the ballistic missile program, end of all support for regional proxies, are preconditions Iran's own officials have categorically rejected on the record. Iran's atomic energy chief stated that enrichment is the foundation of everything they do, and that no outside party can remove that foundation. Iran's supreme leader declared that the Islamic Republic will not be toppled. These are not ambiguous statements. They are categorical rejections issued in public by the individuals who hold actual decision-making authority in Iran. And yet, the frame being constructed in the coverage is, progress was made, talks are ongoing, a deal is possible. This frame serves one specific purpose. If you believe a deal is possible, you believe the geopolitical premium embedded in gold and silver will evaporate. If you believe a deal is possible, you wait. You do not buy ahead of the weekend. You let the price come to you because you expect the fear premium to unwind. That is the function of the diplomatic progress narrative. It manufactures patience in buyers at the exact moment when the operational timeline is shortening. The rule for navigating an information environment like this one is consistent across every cycle. Ignore what is being said and observe what is being done. What is being said? Some progress. A deal is possible. Talks continue. What is being done? A nuclear detection aircraft, a WC-135R, which the military designates the nuke sniffer, has been deployed to the Persian Gulf. B-52 bombers are on a runway in Qatar. 2 carrier strike groups are converging on the region. China is running resupply flights to Tehran. Russia is in the Strait of Hormuz with active warships. These are not the actions of parties who believe diplomacy will resolve this in 14 days. These are the actions of parties preparing for an outcome that words will not produce. There exists a category of evidence that is structurally immune to narrative management. It is the evidence of deployed physical hardware. You cannot fabricate an aircraft carrier in the Arabian Sea. You cannot fake a vault inventory report. You cannot invent a nuclear detection aircraft on a flight manifest. And when both the military hardware and the physical market data are telling the same story at the same time, the narrative running alongside them becomes noise. Let me walk through what the hardware is telling us today, because this is the layer that overrides everything else. The The USS Abraham Lincoln Carrier Strike Group is already in the Arabian Sea. The USS Gerald R. Ford is en route to the eastern Mediterranean. U.S. officials have stated explicitly that the Ford's arrival is a key factor in the timing of operations, not the timing of diplomatic pressure, not the timing of negotiations, but the timing of operations. Over 160 C-17 cargo flights have run into the region since January 16th. THAAD and Patriot missile defense batteries are deployed across the Gulf states. An Ohio-class submarine, location undisclosed, is carrying Tomahawk cruise missiles within operational range. 4 AWACS aircraft are providing airborne command and control, and at Al Udeid Air Base in Qatar, B-52 Stratofortress bombers, aircraft capable of carrying nuclear weapons, have been positioned on an active runway. The WC-135R nuclear detection aircraft is in the region. Its operational purpose is one thing only: detect nuclear material in the atmosphere. When you deploy a nuke sniffer to a region, you are not constructing a bluff. You are preparing to operate in an environment where nuclear material in the atmosphere is a real risk that must be monitored in real time. Now overlay that against the physical silver market. COMEX registered inventory, 88 million ounces. Drain rate, 20 million ounces per month. Timeline to structural delivery crisis at current rates, approximately 4.5 months in a normal environment, before a war premium hits industrial buyers, before procurement officers at defense contractors, EV manufacturers, solar panel producers, and electronics assemblers run the exact calculation described in the mechanism section and simultaneously accelerate their purchasing. If you are Samsung's head of procurement, if you are a Tier 1 defense supply chain manager, if you are responsible for sourcing silver for any industrial application that cannot be interrupted, and you watch a news alert over the weekend that the United States has initiated military operations against the country that controls 20% of global oil flow through the world's most critical maritime choke point, you do not call your broker and ask for the paper price. You call the refiner and ask what premium they require for immediate physical allocation. When that call happens simultaneously across every major industrial buyer, the paper price and the real price separate. The paper mechanism cannot process that kind of concentrated physical demand in real time. That is the moment the spread between the screen price and the real market clearing price closes. Not by the screen price coming down, but by the clearing price moving violently to where the physical buyers are willing to transact. The hardware in the Gulf and the hardware in the vault are reading from the same script. The script says the gap between the current paper price and the real clearing price under the conditions that are actively being constructed right now is larger than anything the trading screen has yet reflected. Here is the framework for the next 48 to 96 hours. 4 scenarios, 4 sets of implications, 1 consistent directional conclusion. Scenario 1, military action against Iran, tariffs upheld by the Supreme Court. This is the most explosive outcome for precious metals of this cycle. Safe haven demand ignites. Oil spikes as Hormuz risk becomes real. Inflation from tariffs continues uninterrupted. Supply chain disruption accelerates industrial silver buying. In this scenario, gold does not simply reclaim its all-time high of $5,589. It exceeds it at a pace the market will not have time to position for. Silver at 80 would represent the entry point that, in retrospect, was obvious. Remember the data point. Gold gained over $1,000 in a single month in January 2026 on Iran war fears alone. That was anticipation. Actual kinetic action is a different magnitude. Scenario 2, military action against Iran, tariffs struck down by the Supreme Court. Complex, but ultimately bullish. Safe haven demand from the military trigger overwhelms the deflationary relief from the trade ruling. War rewrites the oil market overnight. A tariff ruling unfolds over months. In this scenario, gold and silver still move higher, but the path is volatile. Expect 5 to 10% sessions in both directions as the market attempts to price 2 large opposing forces simultaneously. This scenario produces the most extreme intraday volatility of any of the 4. Scenario 3, a deal with Iran, tariffs upheld. No war premium, but structural inflation continues. Gold holds, silver holds. The COMEX vault keeps draining. Miners continue receiving $69 in real settlement for silver. The screen quotes at 80. The U.S. government price floor being constructed under the market remains in place. Central banks continue buying at record pace. The long-term structural thesis is completely intact. No major directional move in the short term, but the foundation for the next leg is being laid every single day. Scenario 4, a deal with Iran, tariffs struck down. This is the one scenario that produces a meaningful short-term correction. War fears evaporate. Inflationary pressure from the tariff regime temporarily lifts. The dollar strengthens. In this scenario, gold could retrace toward $4,500 and silver toward $70. I want you to hold that scenario honestly. Because even if it materializes, even if it is the exact outcome that plays out over the next 4 days, it does not change the structural verdict. The COMEX vault does not magically refill in a deal and tariffs struck down world. The miners do not suddenly begin receiving the screen price. The 16 Chinese military cargo planes that landed in Iran are not recalled. Iran's rearming through Russian and Chinese support does not reverse. The government price floor continues. Central bank buying continues. The global silver supply deficit does not disappear because a court ruled on a trade statute. And most critically, a Trump advisor has placed the probability of military action at 90%. You do not deploy 2 carrier strike groups, nuclear-capable bombers, and a nuclear detection aircraft as a negotiating prop. You deploy those assets when you intend to use them. Iran's supreme leader has said the republic will not be toppled. Iran's atomic energy chief has said enrichment cannot be surrendered. Their parliament still chants death to America on the floor of the legislature. They are simultaneously running joint military exercises in the Strait of Hormuz with 2 nuclear-armed powers. That is not a country constructing a diplomatic off-ramp. That is a country that has calculated it has backing sufficient to refuse. The net directional conclusion: 3 of the 4 scenarios are bullish for precious metals. 1 is temporarily bearish. And even that scenario cannot address the structural drivers that were in motion before anyone said the word Iran this cycle. Here is the final warning I want to leave you with. You can strike down a tariff with a court ruling. You can temporarily push the paper price of silver down with a judicial decision that changes the inflation calculus. You can write headlines about diplomatic progress and manage the perception of retail investors. But you cannot undeploy 2 aircraft carrier strike groups that are already in the water. You cannot unposition B-52 bombers from a runway in Qatar, where they are sitting right now. You cannot put 88 million ounces of registered silver back into a vault that has already shipped them out. And you cannot negotiate a deal with a supreme leader who has stated publicly, in plain language, that his republic will not yield to external pressure. The things in motion right now can only resolve in one of 2 ways: a deal that every available signal says Iran will not accept, or an operation that changes the price of oil, the price of silver, and the price of every real asset denominated in dollars, overnight, without warning, in a gap open that you will read about on a Monday morning if you were not already positioned on the Friday before. Watch 3 things over the next 48 hours. First, does the Supreme Court issue its tariff ruling today, or do they push to February 24th or 25th, the next available session dates? The longer they wait, the larger the refund obligation grows and the more disruptive any ruling becomes. Second, does the USS Gerald R. Ford arrive in the eastern Mediterranean? U.S. officials have stated that arrival opens the operational window. When both carrier groups are in position, the military capability is complete. Third, does Trump issue any public statement narrowing the 10 to 15-day timeline his advisors are already calling shorter? Any single one of those 3 developments moves this market. All 3 in the same window is the kind of event that is not processed gradually by a market. It is processed in a gap. The window you are sitting in right now is the window before the gap. Gold is at $5,027.70. Silver is at $80.37. The carriers are moving. The vaults are draining. The court is deliberating. The Crink Alliance is in the Strait of Hormuz. Hold the line. If this breakdown helped you understand what is actually in motion right now, not what the headlines are saying, but what the hardware and the vault data are confirming, hit like and subscribe. I put this analysis out every single day, and right now, every single day is a day closer to when none of this can be ignored anymore. This is the Asian guy.